It's Friday afternoon. The markets are winding down.
You're looking at your 401k, maybe thinking about weekend plans. But in a windowless room at the Federal Reserve Bank of New York, a phone rings. It's not a routine checkup.
It's a distress signal. This isn't a movie. This happened yesterday.
Traders on Wall Street reported something that hasn't happened in years. The New York Fed, the most powerful arm of the most powerful central bank on earth, started calling major financial institutions.
They had one question: what is the price of the yen? Now, to the uninitiated, that sounds like a boring administrative check.
But to anyone who knows how the plumbing of the global financial system works, that phone call was the equivalent of a jagged line appearing on a seismograph right before a megaquake. Within minutes of those calls, the Japanese yen ripped upward, surging 1.75% against the dollar, the biggest single-day explosion in value since last August.
It clawed its way back to 155.63. Why?
Because the market sniffed out the truth: the United States and Japan are preparing for war. Not a war with missiles, but a currency war to save the Japanese economy from total collapse. But here is why you need to stop what you are doing and listen.
This isn't about Tokyo. This isn't about sushi prices. This is about your mortgage in Ohio. This is about your tech stocks in the S&P 500.
Because if Japan cracks, if they lose control of their currency and their bond market, they have only one lifeline left. They have to sell their assets.
And guess what their biggest asset is?
They own the United States national debt.
If they sell, our interest rates skyrocket.
If they sell, the housing market freezes. If they sell, the soft landing the Trump administration has been promising turns into a hard crash.
Today, we are peeling back the layers of the most dangerous economic event of 2026.
We are going to explain why the US Treasury is suddenly terrified, why Japan is on the brink, and how a rate check in New York might be the signal to liquidate your riskiest assets.
Welcome to the end of the cheap money era. Let's back up. To understand why a 1% move in a currency on the other side of the world matters to your wallet, you have to understand the mechanism. For the last 3 decades, Japan has been the world's ATM.
They have kept their interest rates at zero for so long that the entire global financial system is built on borrowing yen cheaply to buy other stuff: Nvidia stocks, London real estate, Bitcoin.
This is called the carry trade. It is the liquidity engine of the world. But that engine is sputtering. We are entering 2026 with a Japan that looks very different from the Japan of the past.
Under Prime Minister Sanai Takaichi, the government has engaged in massive spending.
They are running the economy hot.
Inflation is rising. And the bond market, the market for Japanese government bonds, or JGBs, is starting to revolt.
Just this past week, the yield on the Japanese 40-year bond hit a record high. Investors are dumping Japanese debt because they don't trust the government's fiscal discipline. When investors dump bonds, yields go up.
When yields go up in Japan, it puts massive pressure on the yen to collapse. Until Friday, the yen was bleeding out, sliding back toward the psychological danger zone of 160 to the dollar, the same levels that triggered panic back in 2024.
So, why did the yen suddenly spike yesterday? Because the big brother stepped in. The rumors are flying that the US government, specifically the Treasury Department under Scott Bessent, is no longer just watching from the sidelines. The fact that the New York Fed was checking rates implies that the US might be joining Japan in a coordinated intervention.
This is rare.
Extremely rare. The US believes in free markets. We usually let currencies float. The last time the US intervened to help the yen was in 2011, after the Fukushima earthquake and tsunami, a literal humanitarian disaster. So you have to ask yourself, if the US is preparing to intervene now, in 2026, what constitutes the disaster? There's no earthquake. There's no tsunami. The disaster is in the bond market. And it's about to spill over onto Wall Street.
I want you to visualize the global economy as two mountain climbers tied together by a rope.
One climber is the US economy. The other is the Japanese economy. For years, Japan has been the anchor. But right now, Japan is slipping off the cliff. Here is the nightmare scenario that keeps Treasury Secretary Scott Bessent awake at night. It's called the JGB Treasury feedback loop. Japan holds over $1 trillion in US Treasury bonds.
They are our biggest foreign creditor. They own the debt that funds our military, our social security, and our roads. When the yen crashes, the Bank of Japan and the Ministry of Finance have to defend it.
To defend the yen, they need dollars to buy yen in the open market. Where do they get those dollars? They have to sell their US Treasuries. Do you see the problem? If Japan gets desperate, they start dumping US debt.
When you dump debt, the price of that debt falls, and the yield rises. If US Treasury yields spike because of a Japanese fire sale, mortgage rates in the US, which are tied to the 10-year Treasury, will jump overnight.
Auto loans get more expensive. Credit card APRs go up.
And most importantly, the stock market creates a valuation based on interest rates.
Higher rates mean lower stock prices. This week, Secretary Bessent admitted he spoke with Japanese Finance Minister Satsuki Katayama. He said the sell-off in Japanese debt affected the Treasuries market.
That is diplomatic speak for you guys are dragging us down with you. The Trump administration has made it very clear, they want low borrowing costs. They want a robust housing market.
They cannot afford a foreign ally blowing up the US bond market just because they can't manage their own currency. This is why the New York Fed made those calls. It wasn't a polite inquiry. It was a signal to the hedge funds, don't bet against the yen, or we will crush you. Economist Jason Furman from Harvard put it bluntly, everyone is on hair trigger. The US is potentially preparing to use its own foreign exchange reserves to buy yen. Why? To save Japan from having to sell US Treasuries. We are essentially paying to keep our own creditor solvent, just so they don't call in our loans. It is a financial hostage situation. To understand where this goes next, we have to look at history. We have to look at the playbook. The US doesn't just wake up and decide to manipulate currencies.
According to the New York Fed's own data, the US has only intervened 3 times since 1996. 1998, during the Asian financial crisis, to support the yen.
2000, to support the euro. 2011, the post-Fukushima coordination. But the most famous example, and the one everyone is whispering about right now, is the Plaza Accord of 1985.
Back then, the major world powers met at the Plaza Hotel in New York and agreed to forcibly devalue the US dollar against the yen and the German mark.
It changed the global economy for decades. Are we looking at a reverse Plaza Accord in 2026? The similarities are striking.
In 2024, Japan spent a record amount, tens of billions of dollars, trying to prop up the yen when it broke 160.
They did it alone. And what happened?
It worked for a few weeks, and then the market swallowed them whole. The yen kept falling because the fundamentals hadn't changed. Harvard's Jason Furman notes that intervention historically has not had persistent effects without a real policy change.
You can't just buy your currency to success, you have to fix your economy. But 2026 is different from 2024. In 2024, the US sat on its hands. We let Japan burn through their reserves. Now, with the New York Fed's involvement, it signals that the US is ready to put skin in the game.
This suggests that the volatility in Japan has become a systemic risk to the United States.
Remember the words of Baipan Rai from BMO Capital Markets, the fact that the New York Fed was asking implies that any potential intervention won't be unilateral.
If the US joins the fight, it sends a message to the short sellers, the traders betting the yen will collapse. It tells them that they aren't just fighting the Bank of Japan anymore, they are fighting the Federal Reserve.
And as the old saying goes, don't fight the Fed. We cannot ignore the political chessboard here. Economics does not happen in a vacuum.
In Japan, Prime Minister Sanai Takaichi is pushing an aggressive fiscal agenda.
She's a spender.
Markets are terrified that her spending will lead to runaway inflation in Japan, forcing the Bank of Japan to hike interest rates aggressively. If Japan hikes rates, the carry trade I mentioned earlier, the free money machine, stops.
Meanwhile, in the US, the Trump administration is laser-focused on the trade deficit. A weak yen is bad for American manufacturing.
When the yen is at 160, Toyota can sell cars in the US much cheaper than Ford or GM.
A weak yen acts like a subsidy for Japanese exporters and a tariff on American goods. So, the interests align. Japan wants a stronger yen to stop inflation and stabilize their bond market. The US wants a stronger yen to protect American manufacturers and prevent a treasury market meltdown.
It seems like a perfect marriage. But there is a catch. Intervention is a temporary drug.
It feels good for a moment, but the withdrawal is painful.
Ed Al-Husseini from Columbia Threadneedle Investment pointed out the real risk. It is possible that the US Treasury is nervous about spillovers. If the US and Japan intervene, they might stabilize the currency for a month or two. But unless Japan stops its massive government spending or the US lowers its own interest rates, the pressure will build up again. And when the dam breaks the second time, it breaks harder.
So, we are at a crossroads. We have a volatile yen, a spooked Treasury Department, and a global financial system running on leverage. What happens next?
I see 3 scenarios playing out over the next 6 months.
You need to know which one we are in to position your money. Scenario 1, the soft intervention. This is what we saw Friday. Jawboning. The Fed makes phone calls. The Japanese Finance Ministry issues warnings.
They might sell a few $1 billion to scare the market.
The result, the yen stabilizes around 150.
The carry trade unwinds slowly.
The S&P 500 takes a small hit but recovers.
Your move, stay the course, but reduce leverage.
Keep some cash on the side. Scenario 2, the shock and awe.
The yen breaks 160 again. The bond market in Japan crashes. The US and Japan announce a massive, formal joint intervention. They flood the market with billions of dollars.
The result, massive volatility. Short-term chaos. Japanese stocks crash.
US Treasuries rally as the intervention creates artificial demand. Your move: this is a buying opportunity for US bonds, but a danger zone for international stocks.
Scenario 3, the doom loop realized. The intervention fails.
The market realizes Japan is insolvent.
Investors panic sell JGBs. The Bank of Japan is forced to print trillions of yen to buy their own bonds.
The yen collapses to 170 or 180.
The result: Japan is forced to liquidate its $1 trillion US Treasury portfolio to survive. US rates spike to 6% or 7%.
The US housing market freezes. The global stock market crashes 20 to 30%.
Your move: this is the black swan.
Gold, commodities, and perhaps even defensive US dollar cash positions become king.
Let's make this tangible. Why does this move so fast?
Imagine a hypothetical hedge fund based in Greenwich, Connecticut. Let's call them Leverage Capital. Leverage Capital borrows 10 billion yen from a Japanese bank at 0.5% interest.
That's about 65 million US dollars.
They take that cash, convert it to dollars, and buy AI stocks and US corporate bonds paying 5%. They pocket the difference.
This is free money.
But on Friday, when the New York Fed made that phone call, the yen jumped 1.75%. Suddenly, the 10 billion yen loan they have to pay back just got 1.75% more expensive in dollar terms. That might wipe out their entire profit margin for the year. If the yen jumps another 5% because of a US intervention, Leverage Capital is insolvent.
They get a margin call. To pay back the loan, they have to sell their AI stocks.
They have to sell their corporate bonds.
Now, multiply Leverage Capital by 1,000. That is the global financial system. That is why a currency move in Tokyo causes a tech sell-off in San Francisco. Bloomberg strategists are already warning that a psychological barrier is forming.
The path for the dollar to go higher is getting narrower. The shorts are getting squeezed.
When these hedge funds rush for the exit, they trample everyone else. We are living through a historical anomaly.
The US and Japan, two of the largest economies, are trying to defy gravity.
Japan wants to spend big without currency collapse. The US wants to borrow big without interest rate spikes. They are leaning on each other like two drunks trying to stay upright. The rate check this weekend was a sobriety test. And the markets are nervous. So, what should you do? 1. Watch the 10-year Treasury yield. If this starts rising rapidly alongside Japanese volatility, it means the contagion has started.
That is bad for stocks and real estate.
2. Watch the US dollar to Japanese yen pair.
If it crosses 155 going down, the intervention is working. If it breaks 160 going up, the dam has burst.
3. Diversify.
The era of easy money from the yen carry trade is ending. The volatility we saw this week in Japan's bond market, the 40-year yield hitting record highs, is a warning shot.
The phone has rung. The Fed has picked up.
Now we wait to see if they can talk the market off the ledge, or if the global economy is about to take a hard fall.
I'll be monitoring the Asian markets as they open Sunday night. If there is a sudden movement, I will post an update on X and in the community tab.
Make sure you are subscribed with the bell on.
You do not want to be the last person to know when the liquidity dries up. Thanks for watching. Good luck out there.